A lot of people think they don't have enough money to invest. But did you know that even a small amount can make a big difference? You can start with just $500 right now, and you might be surprised by how much it can grow when you invest it in the stock market. Not only will it help you start building wealth, but even a small investment can help you develop good investing habits that will help you achieve your financial goals in the future. Let's walk you through an example. If you invest $500 with a 10% annual return, in 10 years you could have around $1,300. If you invest $500 every year, your returns in a decade could exceed $8,000. And if you invest $500 every month, you could have nearly $100,000 after 10 years. Compound interest is a great advantage to investing. Your money earns more money, and as the years go by, the money you've earned also generates returns. Over time, compounding has a powerful effect and can significantly increase the value of your portfolio, even if you initially invested just $500. But you might be wondering where to start with $500, right? Well, let's take a look in this video at some suitable options for you to make investments. Invest with a robo-advisor. If you're new to investing and don't want to choose investments yourself, a robo-advisor is a good choice. It's an online brokerage account that uses algorithms to select investments that suit your needs. When you join a robo-advisor, you'll answer some questions about your goals and risk tolerance. Based on your answers, the robo-advisor will build a diversified portfolio that fits your needs. Robo-advisors save you time and provide peace of mind by making investment decisions on your behalf. Betterment and Wealthfront are popular options for investing $500, and they charge an annual fee of 0.25%. They also offer automatic portfolio rebalancing and socially responsible investing. M1 is another option that combines a robo-advisor with an online broker, allowing you to customize pre-built portfolios for passive and active investing without any annual management fees. Contribute to a 401k or IRA. Investing in a workplace 401k plan is an easy way to start investing, even with a small amount. Your employer sets up the plan for you, and some companies automatically enroll employees, which makes it convenient. One great advantage is that your employer may match your contributions, which can significantly boost your returns. For example, a 3% match means you get a 100% return on your investment. Additionally, 401k contributions are made before taxes, which can lower your tax burden. If a 401k plan is not available to you, consider opening an individual retirement account. IRAs offer similar benefits and give you the option to contribute with pre-tax or after-tax money. Roth IRAs allow tax-free withdrawals during retirement. Both 401k plans and IRAs provide tax advantages, allowing more of your money to stay invested. They are designed for retirement and can provide financial security when you stop working. Investing made easy with commission-free. ETFs managing your own investment portfolio has never been simpler. You don't necessarily need to hire an investment professional anymore. One of the reasons it's so easy is because of exchange-traded funds. ETFs are investment funds that give you exposure to a wide range of assets in one investment. Instead of buying individual stocks and bonds, you can invest in diversified ETFs. ETFs come in different types. You can choose ETFs that represent the entire stock or bond market, or focus on specific sectors. These investments are great if you plan to hold them for a long time, as you can simply buy ETF shares and watch your investment grow. Another advantage of ETFs is that they trade like stocks on stock exchanges. You have the flexibility to buy and sell shares throughout the day, giving you more control over the trading price. Online brokerage firms like Ally and TD Ameritrade offer commission-free trading for ETFs and stocks. Ally even has a robo-advisor option and attractive banking features, such as a high-yield savings account. If you prefer trading from your smartphone and want a social investing aspect, Public is a good choice. Build a diversified stock portfolio with fractional shares. With fractional share investing, you can make the most of your $500 investment by building a diversified portfolio of stocks. Previously, buying shares of larger companies would cost hundreds or even thousands of dollars per share. This would limit your options and potentially concentrate your investment on just one or two stocks. Fractional shares allow you to own a small portion of a share for as little as $1 to $5. While it may seem insignificant at first, fractional shares offer several benefits. They let you buy as much as you can afford, earn compound interest over the long term, and provide diversification within your portfolio. Popular stockbrokers and investing apps that support fractional shares include Charles Schwab, Fidelity, Public, Robinhood, and Webull. Aren't these options quite helpful for making an investment? Well, we are going to share 3 more ways with you. But before that, we'd recommend you subscribe to this channel and turn on the notification bell for more useful videos on finance. Purchase bonds. When you purchase a bond, you're basically lending money to a government or company. In return, they pay you regular interest and return your original investment when the bond matures. Bonds are often seen as less exciting than stocks because they historically offer lower returns and are less prone to sudden changes. However, they play an important role in a well-diversified investment portfolio. The stability of bonds makes them valuable for preserving your capital. Although they may not provide the same level of returns as stocks, their lower volatility means you're less likely to lose money. Another advantage of investing in bonds is the regular fixed income they generate. While stocks may rely on capital gains, bonds provide consistent interest payments throughout their lifespan. You can buy bonds directly from the U.S. Treasury Department or through your brokerage account. Invest in real estate. Surprisingly, you can also invest $500 in income-generating real estate. Thanks to real estate crowdfunding sites, it's now easier than ever to get started. These crowdfunding platforms allow groups of investors to invest in commercial and residential properties. As a shareholder, you can earn dividends on a quarterly or annual basis, and you may also benefit from property appreciation. While many crowdfunding sites have high minimum investment requirements and may require you to be an accredited investor, there are some companies that allow you to invest in real estate with smaller amounts of money. For example, Fundraiser crowdfunding platform has a minimum investment of $10 and charges only 1% in annual management fees. Arrived Homes, a newer player in the crowdfunding space, lets you invest in residential real estate starting at $100. Ground Floor Platform enables you to fund real estate development loans with just $10. Happinest is another new crowdfunding company with a minimum investment of $10. For more options, you can always run research on your own on the best real estate investing platforms for non-accredited investors, which will provide you with a comprehensive list of companies for you to invest in real estate with limited capital. Finally, get rid of your debt. Sometimes it's better to focus on paying off your debt rather than investing. Let's look at the numbers to understand why. Credit cards usually have high interest rates, with an average of 16.13% at the end of 2021, and some rates going over 20%. On the other hand, the average annual return of the stock market is around 10%, around 6% or 7% when you consider inflation, according to the Securities and Exchange Commission. This means that paying off debt could potentially give you a higher return on your money than investing. However, not all types of debt have such high interest rates. Mortgages, auto loans, and student loans often have rates below 5%. In these cases, it might make sense to divide your efforts between investing and paying off debt since the interest rate is lower than the average stock market return. Ultimately, the decision to invest while paying off debt is personal. You can compare the stock market returns to your current debt interest rate to see what makes the most sense on paper. For many people, getting rid of debt is not just a financial decision, but also an emotional one. Eliminating that burden may be more important to them than potential investment returns. Before we wrap up, let me ask you, what investment options are you most excited to explore? Are there any specific industries or companies that catch your interest? Share your thoughts in the comments below. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more valuable content on personal finance and investing. And don't forget to hit the notification bell so you never miss an update.